Thank you all for your time, especially, as I say, we put this just after the football. So thanks for attending. Today's presentation is going to be called Rooted in Retirement. And what I wanted to do today, or actually I probably should introduce myself first. For those of you that don't know me, my name is David Sigri. I'm a retirement key account manager at Aviva, and my role is to support advisors in delivering personalised, compliant later life lending advice and drive good customer outcomes. So I support Julian Harris with that, and I work alongside Che Clark, who is your dedicated business development manager as well. So as I mentioned a moment ago, today's presentation is called Rooted in Retirement. And it's a little bit different from your usual sort of equity release presentation. I'm hoping to sort of highlight some opportunities that you may not have realised there in the equity release market, because we totally understand. One thing I've noticed recently is that it's been a very hard time for financial advisors. With so many economic messages and things like that are changing, the market is very volatile. So it's not been announcements from this trust, cost of living impacts, which were caused probably by that statement. We've had wars in Ukraine, wars in the Middle East to contend with. So markets have just been up and down constantly, which has probably left a lot of people thinking, where's the opportunity when there's heightened rates and LTVs? And those rates and LTVs are really going up and down as well. So it's probably, like I say, trying to work out where the opportunity is as a traditional opportunities, which are still there, of debt consolidation and paying off mortgages and home improvements and that kind of thing. They're probably just not quite as common as they were when market conditions are better. But I'm here to tell you that it's not all doom and gloom. There is still a need for lifetime mortgages, even in this current climate, and it's changing from the traditional client profiles I just mentioned as well. So today's not been about me selling propositions. I know that you know all about the propositions that we've got, although happy to take some questions at the end if you've got any around those. But today's about understanding where opportunity still exists, an opportunity that other advisors may not have identified, and how the later life conversations you have are still an important, relevant consideration for many clients. And that's really what I wanted to explore today in the presentation. So hopefully I'll highlight some opportunities you may not have realised, that gives you more opportunities for later life conversations. But if you guys are sitting comfortably, I shall begin the presentation, which should last approximately sort of 30 minutes, and I have left some time at the end for questions as well. So today's presentation brings together two pieces of Aviva research. Retirement Reality, which was developed with Age UK, and that looks at how people manage money once they're already in retirement. And we've got a piece of research that we did with a company called Centreswide, called Rooted in Retirement, which focuses on how homeowners aged over 55 think about and feel about their homes at that age as well. So together, these pieces of research give us a much clearer picture of client behaviour and not just the behaviour of products. So we're 10 years on from pension freedoms. Many people are now making retirement decisions for the first time without advice, and often without confidence, we're finding as well. And the research I'm about to go through deliberately focuses on non-advised pension holders, which makes, I think, the findings especially relevant, because they're the kind of possibly the type of clients that haven't understood maybe the value of advice, or that they can get advice in the pensions area, which is why they've taken a non-advised route. And these people are navigating complexity largely on their own, and making, as I say, sophisticated or important financial decisions without advice as well. So this is the bit of the part of the survey. No presentation is a good presentation without a survey and a load of statistics. So I'm not going to disappoint you here. I've got a slide which really highlights some important statistics we found from the research with Age UK to begin with. And the survey said that 10% of people felt they were able to live off state pension, which I think we all know on the call here is unlikely. And even respondents felt the same, with many stating that they'd like to have an additional income for life. So, which kind of makes me laugh that even people that hope the state pension will last them for life are saying, I need an additional income. So 83% of the people that we asked the question to confirmed having security of an income for life from pension savings has become more important as they've got older. and the same percentage said they're used to having a certain income, and that would worry them if that level dropped. And then 64% of mid-retirees think their pension should last for life, just regardless, as well. So now I've sort of shared those statistics with you, and I've given you the big numbers there rather than the little 2% number. And the 2% figure that you can see there, they're the mavericks, I'll call them. They're the people that said that they'd be very comfortable with a fluctuating income. So that's obviously not the majority of the people that we spoke to. And all of us working in the industry, even if not working directly with pensions, will know that it's unlikely people will have enough pension savings for it to last them for life, or certainly to keep them in the lifestyle they're accustomed to. And we know people have limited savings, so it will be tough to top up any income. However, many of the clients approaching retirement will own their own home, and by accessing the wealth within their home could help to top up their income, maintain their lifestyle, and most importantly, reduce client worries. And all of us in the room are able to help with that. 10 years as well. So again, hopefully you're starting to get a bit of a feel for the opportunity that's there. And just to underline those statistics and that opportunity that hopefully is beginning to come through here, this slide underlines the client need further for people approaching retirement age. Only 32% of men feel financially secure, and this drops to 19% for women. However, 54% of men and 60% of women feel somewhat secure but have concerns, which tells me there's a conversation to be had. And this is underlined further when you look at the age ranges that people are having these feelings for both genders, which is the average age range of Equity customers. So although this data is from non-advised clients, it also tells me that clients may want a conversation about these worries, but don't know where to go, which means they won't know that accessing their housing wealth may be an option that's available to them. And on the last slide for this research done by Age UK as well, and I know I said at the start of the presentation it wasn't going to be all doom and gloom, and then and now I'm about to go through a slide regarding life expectancy. But it's an important slide, I think, and it's an important slide to consider as the stats on screen show a striking mismatch between perceived and actual longevity. So as we can see here, many still expect retirement to be relatively short-lived, yet the most common age of death is 91, and 1 in 10 people will live to 100. So if people are underestimating how long retirement might last, there's a real risk they underestimate also how long their money needs to last too. And we know from previous slides I've gone through that people want an income to last for life. They understand they may need to top up their income, but they're not sure where they can get that income from. So the key question here is, at this stage, are they considering housing wealth? So from the Age UK research that I've just gone through there, we can conclude that in the UK, people aren't confident, savings are likely not to last, people are living longer, and they probably don't know who to go to for advice or help at that stage as well. So it gives a feel for a real opportunity to have a conversation around housing wealth, I think, as well. But let's have a look at the second study just to sort of back some of that information up in a different way. This second study focuses specifically on homeowners aged 55 and over. It gives us insight into how people think about their homes, not just financially, but emotionally and practically as they move through the retirement stages. And confidence becomes a recurring theme as clients approach retirement age. This is not just confidence in pensions, but confidence in decisions, confidence in plans, and confidence about their future as well. So, looking at this slide here from the research we've done, we found that only 1 in 5 over 55s feel fully confident that their retirement funds will last, which backs up kind of the previous research that we've just gone through. And this sits alongside wider market context as well. The Pensions Policy Institute estimates total UK pension assets at around 3.2 trillion. So I've seen a lot of stats like this shared at the minute. It seems to be anywhere between 3.2 trillion and 3.4 trillion, but still, that's an awful lot of wealth. And it's a major shift towards those pension assets are shifted towards defined contribution schemes, as you'd expect as well. So, and while the defined contribution, or what's known as money purchase schemes, whilst that participation has grown significantly thanks to things like auto enrolment, we're also seeing a crossover effect at retirement where people moving workplace pensions into drawdown, annuities or SIPs. And this is all good stuff, but they're also doing this without a long-term plan for sustainability. And this is where I'm going to move the conversation away now from pensions and look beyond that to how people feel about their housing as well. So we can just sort of join those two bits of research up. Because while pension confidence is fragile, people's home often represents still certainty, stability, and control for them. And as we can see from the research from Census Wide, for nearly half of over 55s, leaving their home would feel like losing part of their identity. And in the UK, our home is still very much our castle. And the longer someone's lived there, the stronger that attachment becomes. And it's not surprising to see that as well, because why wouldn't it? It holds many family memories, and it's been invested in over a number of years. And homes aren't just assets; they're places, special memories have been created as well. Now seen probably as sources of well-being. It's where we go after we've had tough times and busy days and that kind of thing. And it also provides a sense of achievement. It's an evidence of what we've achieved through the hard work we've put in over our lifetimes. And that emotional value heavily influences whether property is ever seen as available within financial planning to customers, especially if they're not receiving advice. So as you have all come across before, for many people, property isn't just about lifestyle. It's also about having some sort of legacy as well. And quite often, the subject of downsizing is discussed as well. And downsizing is often assumed by customers, but rarely tested. We find as well, and it's probably something you guys find as well when you speak to customers. And as we can see from the stats, the biggest barriers aren't financial alone. Finding the right home, the physical effort of moving home, and disruption involved are all heavy considerations for many. And this is why when people say we'll just move later, this often remains an intention or an aspiration rather than a plan, or it seems like a reasonable plan until reality hits. And then the clients aren't too sure whether actually they really want to move. And hopefully by that stage, it's not the only option available to them. And this is an interesting slide as well, because it kind of backs up what we just said there about if people do move, it's about a lot of other factors than when they were younger as well. Because when people do consider moving, it's usually lifestyle led when they're in sort of retirement ages, and which means that access to things like amenities, having social connection, and community, and maybe even being close to family as well, matter more than square footage or price alone. Which is really what when we're looking to buy a property when we're younger, it's kind of what we're conditioned to think. It's like it's an investment. How's it going to make us money? We need to have as many bedrooms as possible, as much square footage as possible. And I think what this does is it reinforces that property decisions in later life they're not transactional, they're deeply personal. There's more to consider for people in later life when they're looking to sell or downsize their property than the statement we'll just downsize. And as we can see here, 7 in 10 retirees are choosing to renovate rather than move. And this certainly backs up. Although I'm not at retirement age yet. I'm getting older. I do live in an area where there are more retired people. But when I walk around my area, I certainly see some more skips on the drive than for sale signs at the end of the driveway, which kind of backs that up a bit as well, I think. And for many, staying put feels easier, safer, and more familiar, especially when there's no immediate financial process to change. So, and this also aligns with what I recently read from a report shared by Fairer Finance, which also highlighted that for most households today, household wealth now exceeds pension wealth, which again, when we're looking at those sort of 3.2 trillion figures, that's obviously a big number as well. Yet, although now housing wealth is exceeding pension wealth, it's rarely treated as part of the planning conversation. And when you say it out loud and you see a lot of the research we've gone through today, it seems like madness that that's the case. So we mentioned earlier that property isn't just about lifestyle, it's about legacy as well. And again, many retirees would rather gift their home than set up and pass on what they make to their family. And this reinforces why housing wealth is often treated as fixed and untouchable. And to be fair to customers as well, this isn't wrong. It's just not a full view. It's not looking at the bigger picture, I don't think. And the key issue is whether housing wealth is consciously considered rather than silently ignored. And again, when we're looking at non-advised clients, as we have been through research as well, again, that's going to be quite impactful as well. It might be, they're subconsciously thinking we can't think about the home as well as not being aware that they can access the wealth from their home as well. And when you overlay all of what we just mentioned there with the rising living costs, it's no surprise that pressure starts to build for customers as well. I mean, we have enough concerns anyway, and then when you add all those on as well, it's no surprise that that's starting to knock their confidence, and they're not too sure to do. And nearly half of over 55 say rising costs are impacting their retirement lifestyle, particularly women and younger retirees. We're also seeing more defined contribution pots being accessed earlier, with many smaller pots fully withdrawn before the state pension age as well. And that raises the risk of people having pension shortfalls, especially amongst disadvantaged and vulnerable groups. And this brings us to housing wealth and how it fits into the wider picture with equity release. So I mentioned at the start of the presentation that this is that there's an opportunity in the market at the moment, despite adverse market conditions, and later life conversations are still really relevant. And over 80% of people haven't considered equity release, despite, as we discussed throughout the presentation, growing anxiety about retirement income. But this isn't about equity release being a default solution. It's about recognizing that you guys, as qualified mortgage advisors, are often the only professionals actively discussing property with later life clients. And IFAs are often unaware of it and walk past it as well. And this is where it's important for you to understand this opportunity so that you can consider helping your clients, but more importantly, make strong referral relationships with estate agents and IFAs. See who within the network, isn't aware of the lot of the things we mentioned today and might be able to refer you over clients. Find ways of collaborating with these professional connections to identify these customers and ultimately help them. There's an ideal opportunity coming up in a minute to do so as well. The pension dashboard is due to launch in the next, I believe, next year. The sign-off's been agreed for the end of this year for providers to be ready for it. And when that does launch as well, I think the reality of how little people may have saved will hit home to them. And there will even be people, I believe, as well, that have saved regularly throughout their lifetime, thinking they've probably got a larger nest egg than they have. And when they come to look at it, there's going to be an oh gosh moment. And they'll need to know who can help them. The people that can help them are everyone on this call, basically. So what does this mean in practice, what I've been through today from the research that we shared? Well, it doesn't mean that everyone over 55 should consider equity release or later life lending. And it certainly doesn't mean stepping outside your regulatory permissions either. What it does mean is having a subtle shift in mindset, not just what products are suitable today, but looking at how does the decision affect future flexibility for the customer? What does a client's financial future look like as well? And what's worrying them? Again, the simple question of what's worrying you quite often can open up the floodgates for a lot of information as well. And these conversations are not only aligned to a lot of the points being highlighted throughout the presentation, but also points that are being highlighted and raised currently by the FCA as well. And these things that the FCA are highlighted are being like joining up the mortgage market, more holistic advice, and including later life lending. These will present new opportunities to you all as advisors. So that's pretty much my presentation today. It's a little bit quicker than I expected, but hopefully it's really highlighted an opportunity that you may not have considered or realised was there. And I know at the start of the presentation, I promised that I wouldn't do a proposition push. And I know that you know a lot about our propositions and things like that, but I can't spend 25 minutes or so presenting to you guys without letting you know how Aviva can help you with what we've been through today as well. So firstly, how can we help you? Well, I think Aviva, being the name Aviva, can give clients some confidence that lenders who can help. As a competent insurer as well, we are the only lender who can help your clients from child ISA through to long-term care as well, which makes us well placed to highlight and assist you with the themes that we've discussed in today's presentation. And hopefully as well, when people are, again, a little bit like other later life lending products you used to discuss, especially equity release, when people know that Aviva, trusted brands like Aviva and other trusted brands in the market, they're a little bit more inclined to find out more and speak about that as well. And again, as you can see from the stats on the screen, I like to get these in on every single presentation, but we really do know what we're doing as well. We've helped over 300,000 people release over £11 billion since 1998. So, and we're constantly trying to innovate the market as well, which again, it's not always about products innovating. Sometimes it's about sharing new ideas, which is what I've looked to do today with the presentation. So hopefully it's highlighted some opportunities in the market to help some new clients that you may not have otherwise realised required help. So I just wanted to thank you guys today for your time and just open up the floor for any questions that you might have.
Well, thank you for that. And maybe I'm the only one to ask the questions. I don't know if Mohan's got any questions. But you mentioned additional income for life. Is there any plans within the industry to provide any sort of plans for clients so that via equity release they can have an additional income for life?
It's certainly an area that I think all lenders in the market are looking at the moment. Talking to a lot of other lenders in the market, and again, I talk to a lot of advisors and ask them what innovation looks like. Because we're always asked, can we bring out new products or can we innovate the market? And a key theme is how can we sort of connect the wealth market with later life lending. So although there's nothing immediately on the horizon, I would be very surprised if lenders aren't looking at ways that they can provide sort of a wealth style or income style equity release product that can help clients with a lot of these concerns that they have. And the opportunity that I've mentioned.
You'd be able doing it that way. You'd be able to kind of have some sort of direct comparison between the kind of pension market and the equity release market for providing incomes. I think from that perspective.
The one thing that we have to look at, just watch when we're looking at these kind of products, is just that they haven't become a pension product, and that you need, a level 4 qualification to do the wealth part. So I think there's certainly ways that you could look to do that, but I think that's probably what lenders will need to look at and be aware of. So that, but it's like we've mentioned, you guys with mortgage and later life permissions are really well placed to work with the IFAs to help these customers. But again, I guess one thing to be aware is we bring out a product that's wealth management driven. As helpful as it will be, you probably need permissions to be able to provide that product. But as I say, this is an area that I would be amazed if lenders aren't looking at, and they'll be looking at it from an equity release lens as well.
Yeah, because every time you take a drawdown, I guess that ERC clock starts ticking again, and you have a new kind of offer and a different interest rate, and it becomes very, very messy and untidy.
Yeah,
I guess the only
also you don't know how long it's going to last for either, do you, Phil? That's the problem as well. So
yeah, no, I understand that, but I really do think that is kind of an area that can be looked at for people to use their properties in order, instead of just drawing a lump sum and then paying interest on that lump sum from day one. If they're able to draw down a very small amount, they'd be paying a lot less interest charges over the period of the time that they actually draw it.
I think also, as good as drawdown reserve is, and it helps in this area if you're topping up income. We've mentioned there that some people are going to have lower incomes than others, so actually maybe a drawdown top up won't be enough. Again, it's hard to probably work out how much loan that you'd need to secure or agree in order to keep the longevity of that income. So, like you say, I think an income style product is required for the market that looks just at that, where maybe you wouldn't maybe look to take the equities product or the loan for anything other than income as well. So I think that's probably the area that the market needs to look at. But as I say,
it kind of needs specialist products that sit alongside the traditional products. Just to give you an opportunity to talk a big up Aviva a little bit as well. Your 10% uplift on interest. Do you want to mention that? And do you automatically send out clients on completion a direct debit form so that it would encourage them to take advantage of this opportunity?
Yes, we do. There should be a direct debit form that goes out as well, and there's that direct debit form is also on our documents library that you can download and give to them as well. But really good point. At the end of last year, we refreshed what used to be known as Lifestyle Flexible Option. It's now called Lifestyle Flexible Advantage. It does exactly the same thing that the previous product does, in the sense that it's medically underwritten. It's a lump sum product that provides a reserve. But as Phil's quite rightly highlighted there, the products, and when the product took a refresh, we enhanced the voluntary partial repayment feature. So basically, we've had lots of great feedback about the interest reward style products and how useful they are for customers. The only piece of feedback that we got with customers that maybe didn't take it forward but liked the idea was that they were apprehensive about looking into a term and if their circumstances changed or whether their interest rate might move. So we've looked to sort of address those concerns, if you like, and bring an alternative out for people that aren't maybe ready or have apprehension around taking interest rewards. So with the Lifestyle Flexible option, the interest rate will be the interest rate that you source. But if a client makes a voluntary partial repayment, where that voluntary partial repayment makes up an interest payment, which pretty much is all of the voluntary partial repayment when you're doing it, then Aviva will pay an additional 10% on top. So an easy example would be for clients happy to pay £1,000 as a voluntary partial payment, and that £1,000 is just paying off interest. Then Aviva will pay an additional £100 on top. Now, with the feature, the voluntary partial payment rule is still in place, where the client can pay 10% of the loan a year. So where a client wants to service the full 10%, we have a really useful calculator which is on air sourcing. I think it's called the Forecaster tool, and we have it on our website where it will work out what the client needs to pay, so that we'll pay the 10% on top, and they don't go over that maximum 10% as well. So that way they can be fully service interest or pay the entire 10% they want. And again, they will still take advantage of us adding the 10% bonus on top, which helps them to reduce the payment quicker. Now, the benefit of this, as I mentioned, is that there's no term to this. So if the client wants to do it on an ad hoc basis, so they want to pay this month, they want to pay £1,000, but then not pay for 2 months, that's absolutely fine. But then next look to make the voluntary partial payment, we'll add the bonus at that stage. If they don't pay it, we don't add it, which is why we don't change the interest rate.
Yeah.
But the thing to be aware of is that we might not be the most competitive interest rate at times, but we may well have if someone is paying a regular voluntary partial payment, so they set a direct debit up for a monthly basis, especially, then it might be that we have a better total cost of borrowing than the lowest interest rate. So that's something to really be aware of. But the Forecaster tool is on air and compound interest calculator on our website really illustrates this well for your customers. So it does this well in 2 ways. You can put the details in, so it can tell you what the client needs to pay, and then you can convert that to a PDF, and it will then show you as a graph the impact of the client not making the payment, the impact of the client making the payment as well with the bonuses, so they can see that, and you can personalize that output sheet for the customer as well. So if they don't take it forward, it's brilliant for you guys just to download, pop it in the file, so that you can show compliance or whoever in the future that you had those conversations, and whichever decision the client looked to take forward is, that's a decision that's an informed decision, basically.
Yeah, excellent, good. Yeah, it's certainly a great incentive to try and get people to actually make one or two payments.
Thanks for mentioning as well. We get a lot of good feedback from it. It's just taking a little bit. It's just because it's a little bit different. It's just taking us a bit of time just to educate people, or just remind people, actually, not educate, remind them just about the total cost of borrowing with Aviva, as well as the rates. So hopefully that's working for more people.
You reduced for the old policies. I think memory tells me that you reduced your length of your ERCs on the older policies as well. I guess this uplift isn't going to be brought in for those older policies now, is it?
No, it's not at the moment.
No.
So because it's new, it's something that we have on the the backlog to check. So it could be something that changes in the future. But at the moment, it's just for people that have the lifestyle advantage policy rather than the lifestyle flexible option. Now, the people that have the lifestyle flexible option can still make voluntary partial repayments, and they can still set them up as a direct debit if they wish. But because it's on the old terms, it doesn't attract a 10% uplift. It's also worth noting that it's not on the Lifestyle Max product, just the Lifestyle Flexible Advantage product.
Flexible Advantage product, yeah. Okay, excellent. Okay, excellent. I think that's all for me. The only other thing is you mentioned the amount of business that you've actually done and the amount of lending that you've done. Do you know roughly what your percentage share of the market actually is?
It's around roughly it's around 17%.
All right, okay. That's good.
Give or take, depending on the market.
Yeah. No, I just wanted to get some sort. I didn't really have any indication as to where you were in terms of market share, etc. That's fine. No, all good from me. Thank you very much for that.
Phil, thank you for your questions. Really appreciate it, man. Thank you.
No problem at all.
Thanks, David. Thanks, Philip, for your questions.
All right. Yeah. See you again soon.
Thanks.
Yeah, thanks, Philip.
Cheers, Dave.
Thanks, Myron, as well. Have a great day, guys.
You too.
Bye now.
Bye-bye. Bye-bye.